When you hear the words financial crash, what's the first thing that pops into your head? For just about everyone, it's 2008, right? Falling stocks, housing market in chaos, a credit crisis that went global. That event is seared into our collective memory. It's the blueprint for disaster. But what if preparing for a repeat of 2008 is the single biggest mistake we could be making? What if the real crisis is already happening and it looks absolutely nothing like what we're all expecting?
Okay, so here's how we're going to break this all down. First, we'll talk about why we might be preparing for the wrong crash entirely. Then we'll get into the two very different types of economic collapse. We'll pinpoint where the real bubble might be hiding. We'll look at the warning signs that are flashing right now, tackle the weird paradox in the housing market, and then we'll explore the potential endgame.
So let's start with 2008. It's the ghost in the machine, right? It's the event that anchors all our thinking. We're all conditioned to look for the same signs: falling stocks, another housing bust. But what if that very expectation, that memory, is our biggest blind spot?
And that really brings us to the core question here. Are we building a fortress to defend against an army that isn't even coming, all while leaving the back gate wide open to a totally different kind of threat?
This slide just lays it out so clearly. On the left, you've got the 2008 playbook we all expect: a deflationary crash where asset prices collapse and cash is your best friend. But on the right, you have a completely different beast: an inflationary crisis where cash becomes trash and the price of hard assets seems to launch into orbit.
To really get our heads around this, we have to understand that not all collapses are created equal. The outcome, who wins, who loses, it all comes down to the fundamental nature of the crisis. So let's nail down the definitions of these two very, very different events.
First up, the one we all know and remember, the deflationary crash. This is 2008 in a nutshell. A massive credit bubble popped, and the price tags on everything, stocks, bonds, houses, went down. And in that world, cash was king. Your dollar could suddenly buy more, not less. Now, as painful as it was, that crash kind of acted like a reset button, letting people with cash buy assets for pennies on the dollar.
Now, an inflationary crash is the polar opposite. This isn't a crisis in one market, like housing. No, this is a crisis of the money itself. It's when faith in the currency just evaporates. And here's the tricky part. The nominal price of assets doesn't fall, it explodes upwards. But it's just a mirage. It's a symptom of wealth desperately trying to escape a dying currency. In this scenario, that reset button is broken. You can't buy the dip when the dip is the actual money in your bank account.
And when you put them side by side, man, it's just night and day. What was the safest thing to hold in 2008, cash, becomes the absolute riskiest position. The winners and losers are completely flipped. It's no longer about who has the most dollars. It's about who owns real, tangible stuff. It is a total inversion of the last crisis.
So, if the real bubble isn't in things like housing or tech stocks, then where is it? Well, the argument goes that the problem isn't a crack in one of the walls of the financial house. It's a crack in the very foundation itself.
You know, we're all trained to look for bubbles in the usual places, right? The NASDAQ, the real estate market. But what if the greatest vulnerability, the most over-leveraged asset in the entire world, is something we've been told our whole lives is the definition of safe?
And there it is. The central argument is that the biggest bubble in human history isn't in stocks at all, it's in the assets we've always considered risk-free: government bonds, and by extension, the fiat currencies that are backed by them. The idea is that the illusion of safety was built on a promise of responsible spending that, well, that's long gone.
So how does this actually work? Well, it's been described as a doom loop. It goes like this. The government needs to borrow trillions just to keep the lights on. But who's going to buy all this new debt? Increasingly, it's the central bank itself, which just creates new money out of thin air to finance the government's spending. This isn't a free market anymore. It's a closed loop. It's like a snake eating its own tail, and eventually that just destroys confidence in the whole system.
Okay, but look, this isn't just some far-off theory. The argument is that this shift is already happening, right now, in plain sight. The warning signs are flashing if you know where to look.
Let's just take the stock market, for example. In a healthy market, you see a broad rally, lots of companies doing well. But today, the entire market is basically being propped up by just a tiny handful of mega-cap tech stocks. Look at that. Over a third of the S&P 500's entire value is in just 7 companies. This isn't seen as a sign of strength. It's seen as a desperate, pseudo-safe haven bid. Capital doesn't trust the broad market anymore. It's all piling into a few corporate fortresses that seem safer than the currency itself.
And it's not just the stock market.
I mean, look at what else is hitting all-time highs. Gold, Bitcoin, even fine art. Now, these assets don't usually all move together like this. When you see them all surge at the exact same time, it suggests something much deeper is going on. It's not just random speculation. It's a coordinated flight from fiat currency into anything with real, provable scarcity.
And nowhere is this whole distortion more obvious or, frankly, more painful for the average person than in the housing market. We've just lived through one of the fastest rises in mortgage rates in history. Now, in any normal market, that should have sent prices crashing down, but they haven't. And this is the great housing market paradox.
So how in the world did we get here? Well, this timeline kind of breaks it down for us. For decades, subsidies pushed prices up. Then, the zero interest rate frenzy of 2020 and 2021 let millions of homeowners lock in these unbelievably low mortgage rates. And that has created the bizarre situation we see today. A completely frozen market, absolutely starved of houses for sale.
And it leads to this incredible analogy, the golden handcuffs. It's perfect, right? Existing homeowners are trapped. They can't sell because if they did, they'd have to give up their amazing 2 or 3% mortgage and get a new one at today's much higher rates. Their monthly payment would just explode. So what do? They stay put. And that starves the market of inventory and keeps prices artificially sky high for anyone trying to buy a first home.
And this whole frozen market thing, it's a huge problem for the banking system. Just think about it for a second. The banks are sitting on balance sheets filled with these 2-3% mortgages, but their own cost of borrowing money is now over 5%. That means every single good loan on their books, every loan that's being paid on time, is actually losing them money every single month. This is the exact same problem that blew up Silicon Valley Bank. Their safe assets became the very source of their collapse.
So where does this all lead? I mean, what's the end game when all of these immense pressures, the debt bubble, the frozen housing market, the fragile banks, what happens when they all finally converge?
The thing is, the central banks are, well, they're trapped. They're in a trap of their own making. If they keep raising rates to fight inflation, they risk bankrupting their own governments who can't afford the interest payments. But if they cut rates to save the system, they'll unleash a firestorm of inflation. So you've got insolvency on one side and currency destruction on the other. There's no easy way out. And that's why this isn't being framed as just another crisis. No, this is being called the greatest redistribution of wealth in modern history. The losers are the ones who followed the old rules. Savers with cash in the bank, retirees on fixed incomes, conservative bond investors. And the winners? The owners of scarce, real assets that can't be printed into oblivion. The people who understood that the rules of the game had fundamentally changed.
And really, that is the ultimate takeaway here. This isn't about a market just resetting to start a new cycle. It's being presented as the end of an entire era, an era built on paper promises and the idea of infinite debt. It's a painful transition away from that system toward a new one that has to be built on something tangible, something provable, and something scarce.
And this forces us to ask a really fundamental question. For the last 50 years or so, wealth has basically meant accumulating dollars and paper assets. But if the very foundation of that system is cracking, then everything we think of as wealth, everything we work for and save for, might be on the verge of a historic redefinition. What will value even mean in the world that comes next?